Real estate tax pitfalls and how to avoid them. Chapter 1. Chapter 1. Tax appeals and errors in depreciation.
Missteps in property tax appeals.
Property tax appeals can be a valuable tool for homeowners and businesses seeking to reduce their tax burden. However, the process is complex and fraught with potential pitfalls. Understanding common missteps can help taxpayers navigate the appeals process more effectively and avoid costly errors. First, one common mistake is failing to understand the basis for an appeal. Taxpayers must have a clear reason for contesting their property tax assessment, whether it's based on incorrect property information, unequal assessment compared to similar properties, or an overall overvaluation. Without a solid foundation, the appeal is likely to be dismissed. Another frequent error is missing deadlines. Property tax appeal deadlines are strict and vary by jurisdiction. Missing a deadline typically means losing the opportunity to appeal for that tax year, resulting in continued overpayment. It's crucial to be aware of and adhere to all relevant deadlines. Inadequate preparation is also a significant misstep. Successful appeals require thorough documentation and evidence to support claims. This includes recent property appraisals, sales data for comparable properties, photographs, and repair estimates. Presenting a well-prepared case increases the likelihood of a favorable outcome. Taxpayers often underestimate the importance of understanding local tax laws and procedures. Each jurisdiction has its own rules and processes for property tax appeals. Familiarity with these specifics can prevent procedural errors that might invalidate an appeal. Consulting with a local expert or attorney can provide valuable insights into the nuances of local tax law. Many taxpayers fail to seek professional help when needed. While some appeals can be handled independently, complex cases or significant potential savings may warrant hiring a property tax consultant or attorney. These professionals have expertise in navigating the appeals process and can often achieve better results. Another issue is the lack of proper follow-up. Even after filing an appeal, it's important to stay engaged and responsive to any requests for additional information or hearings. Failure to follow up can lead to dismissal of the appeal or an unfavorable decision. Taxpayers sometimes focus too narrowly on the immediate tax year in question. It's beneficial to consider the long-term implications of an appeal, including how a successful appeal might affect future assessments and taxes. Understanding the broader impact can help in making informed decisions. Finally, it's important to manage expectations. Not all appeals result in significant tax reductions, and some may not succeed at all. Being realistic about potential outcomes can reduce frustration and help taxpayers remain focused on the overall strategy for managing property taxes. In summary, property tax appeals can be an effective way to reduce tax liability, but the process requires careful attention to detail and adherence to procedures. By avoiding common missteps, taxpayers can improve their chances of a successful appeal and ensure they are not overpaying on their property taxes.
Errors in depreciation calculations.
Depreciation is a key component in real estate tax management, allowing property owners to deduct the cost of tangible property over its useful life. However, errors in depreciation calculations can lead to significant tax issues, including underpayment or overpayment of taxes. Understanding common errors can help property owners avoid these pitfalls. One of the most common errors is misclassifying property. Depreciation rules differ for various types of property, such as residential rental property, commercial property, and equipment. Incorrectly classifying property can result in using the wrong depreciation method or recovery period, leading to inaccurate deductions. Another frequent mistake is failing to allocate the purchase price correctly. When acquiring a property, it's essential to allocate the purchase price between the land and the building, since land is not depreciable. Incorrect allocation can distort depreciation calculations and lead to non-compliance with tax regulations. Incorrect useful life assumptions also cause errors. The IRS provides guidelines for the useful life of different types of property, but taxpayers sometimes use incorrect periods. For instance, residential rental property typically has a useful life of 27.5 years, while commercial property has a 39-year life. Using the wrong period can significantly impact the amount of annual depreciation. Improper use of depreciation methods is another common error. The modified accelerated cost recovery system is the standard method for most properties placed in service after 1986. However, some taxpayers mistakenly use older methods or incorrect MACRS conventions, leading to inaccurate calculations. Neglecting to depreciate improvements separately can also cause issues. Improvements to a property, such as new roofs or HVAC systems, should be depreciated separately from the building itself. Failing to do so can result in underdepreciation or overdepreciation, affecting the overall tax liability. Errors often occur when handling dispositions of property. When a property or a portion of it is sold, demolished, or retired, the remaining undepreciated basis must be removed from the books. Failing to properly account for dispositions can lead to errors in calculating gains or losses and ongoing depreciation. Another significant mistake is missing bonus depreciation or Section 179 deductions. Tax laws periodically change, allowing for accelerated depreciation methods like bonus depreciation or immediate expensing under Section 179. Failing to take advantage of these provisions can result in lost tax benefits. Some taxpayers fail to adjust depreciation schedules for changes in use. For example, converting a property from personal use to rental use requires adjustments in the depreciation method and useful life. Overlooking these adjustments can lead to non-compliance and potential penalties. Lastly, improper record keeping is a common issue. Accurate records of purchase costs, improvements, and depreciation claimed are essential for proper calculations and for supporting deductions in case of an audit. Poor record keeping can lead to errors and difficulties in defending deductions. In conclusion, accurate depreciation calculations are crucial for maximizing tax benefits and ensuring compliance with tax regulations. By being aware of common errors and taking steps to avoid them, property owners can effectively manage their depreciation deductions and minimize their tax liabilities.
Chapter 2, Deductibles and Reporting.
Overlooking deductible expenses.
Overlooking deductible expenses is a common mistake that can lead to higher tax liabilities for property owners. Ensuring all eligible expenses are accounted for can significantly reduce taxable income and enhance cash flow. Understanding and identifying these expenses is crucial for effective tax management. One frequently missed category of deductions is maintenance and repairs. Routine maintenance, such as painting, fixing leaks, and minor repairs, is fully deductible in the year incurred. These expenses are often overlooked or incorrectly capitalized, reducing the immediate tax benefit. Another commonly overlooked expense is property management fees. If you hire a property management company to handle day-to-day operations, their fees are deductible. This includes tenant screening, rent collection, and maintenance coordination fees. Properly accounting for these costs can lower your taxable income. Utilities and services are also deductible but often missed. Expenses for water, electricity, gas, and trash removal directly related to rental or business properties can be deducted. Additionally, costs for services such as landscaping, pest control, and security systems are deductible business expenses. Insurance premiums are another critical deductible expense. Premiums for property insurance, liability insurance, and even mortgage insurance on rental properties can be deducted. This is an essential area to review annually to ensure all premiums paid are properly accounted for in tax filings. Professional and legal fees can also be deducted. Fees paid to attorneys, accountants, and consultants related to property management or investment advice are deductible. These expenses are often overlooked or not fully accounted for, leading to missed deductions. Marketing and advertising expenses are deductible as well. Costs for online listings, print advertisements, and promotional materials used to attract tenants or buyers can be deducted. Ensuring these costs are tracked and included can provide substantial tax savings. Travel expenses for property management are another area often overlooked. If you travel to manage, inspect, or repair rental properties, travel expenses such as mileage, airfare, lodging, and meals can be deductible. Proper documentation and adherence to IRS guidelines are essential to claiming these deductions. Depreciation of assets related to the property, such as appliances, furniture, and equipment, is another significant deduction. Ensuring that all depreciable assets are included and properly accounted for can maximize tax benefits. This requires meticulous record-keeping and understanding of depreciation schedules. Lastly, home office expenses can be deductible if part of your home is used exclusively for business purposes related to property management. This includes a portion of your mortgage interest, utilities, and home maintenance. Properly calculating and documenting these expenses is crucial for compliance and maximizing deductions. In conclusion, overlooking deductible expenses can result in unnecessary tax payments and reduced cash flow. By being diligent in identifying and claiming all eligible expenses, property owners can optimize their tax position and retain more of their income.
Non-compliance with reporting requirements.
Non-compliance with reporting requirements can lead to serious tax penalties and legal issues for property owners. Understanding and adhering to these requirements is essential for maintaining good standing with tax authorities and avoiding costly mistakes. One common area of non-compliance is the failure to report rental income accurately. All rental income must be reported on tax returns, including payments for rent, security deposits used as rent, and any other rental-related payments. Inaccurate or incomplete reporting can trigger audits and penalties. Another frequent issue is improper reporting of expenses. Property owners must ensure that all deductible expenses are properly documented and reported. This includes keeping detailed records of repairs, maintenance, management fees, and other costs. Failure to do so can result in disallowed deductions and increased tax liabilities. Depreciation reporting is another critical compliance area. Property owners must calculate and report depreciation accurately, adhering to IRS guidelines. Errors in depreciation can lead to underreported income and subsequent penalties. Keeping precise records of property basis, improvements, and depreciation schedules is crucial. Foreign property owners must be aware of additional reporting requirements, such as those under the Foreign Investment in Real Property Tax Act, FIRPTA. Non-compliance with these requirements can lead to withholding penalties and other legal issues. Understanding and fulfilling these obligations is essential for foreign investors. Timely filing of tax returns and payment of taxes is another vital compliance aspect. Missing filing deadlines or failing to pay taxes on time can result in penalties and interest charges. Property owners should stay informed about relevant deadlines and ensure timely submissions. In conclusion, compliance with reporting requirements is essential for avoiding penalties and maintaining good standing with tax authorities. Property owners should stay informed about their obligations, maintain accurate records, and seek professional advice when necessary to ensure full compliance. Thank you for watching. If you enjoyed this video, please give it a thumbs up and let us know in the comments below. Don't forget to subscribe to our channel for more great content like this. Hit the bell icon to get notifications whenever we upload new videos so you never miss out. We appreciate your support and look forward to bringing you more exciting videos.
The voices in this recording were created with the assistance of OpenAI.